All right, thank you very much, Travis. I appreciate your time and your hosting this exciting event. I'm excited to talk about something that I think is very apt to what's happening in the market right now. But let's talk about the markets, because a lot of times people get a little bit disgruntled, a little bit despondent about what's happening. And what I hopefully can turn around and just like the last speaker, it's having the right attitude, the right approach to the market. First thing I want to make sure is everybody can hear me. And I want to be able to see the audio bars. It looks like we're able to see the audio bars. Correct. Good deal. Good deal. So we're going to talk today about how to take advantage of what the markets have to offer. Any and all market conditions. Right now is a fantastic and amazing time in the marketplace for many reasons. We're going to get into that. First thing I'm going to tell you, you can see my picture there. I do financial television on a regular basis here in Chicago. And hopefully they have me on for a couple of different reasons. Hopefully because I'm more of a straight shooter and I'm going to tell like how I see the market and what the specific opportunities are, what I want to buy, where I want to buy it, and what I want to risk. And that's a little bit different than most of the infotainment that goes on television. Usually I tell people to turn the TV off. I know we like to keep it on in the background, the Bloomberg, the Fox Business, or the CNBC, but a lot of times it can lead to emotional trading and undisciplined inaction. So understand what you're getting when you do watch those financial channels. They're there not to help you make money, but they're there to profit by selling advertising. So they want to keep you engaged and excited. I don't think excited is the right word. I think fearful is probably the best word. So just be aware of that. So let me talk about why I think this is the best time to participate in the markets. And right now is the time for a number of reasons. So people are going to sit there and say, well, you know, this is not a great time in the marketplace. That is not true. There's always opportunity, and that's what I want you to walk away from here today, is recognizing there's always opportunity. A couple of reasons this is the best time in history: because of electronic access. I'm here at the Chicago Board of Trade. I dabbled in the Treasury bond pits, and back in the day, you could only trade the market you were in. If you had a badge and you were in a pit, if you were in the crude pit, you could only trade crude. If you were in soybeans, you could only trade soybeans. So if it wasn't happening there, you couldn't just pick up and trade wherever the action was, wherever that opportunity was. So you learned a valuable lesson very quickly, or you didn't, was that if you try and force trades, that oftentimes, you know, that's to your detriment. So if it's not there, you need to either step aside or find other opportunities. Now with electronic access, you can trade any market, any direction, any time. So if it's not happening, you can go into currencies, you can go into futures, you can go into options, you can go into Chinese stock market. You can trade anything, anytime. It's not about what you trade, it's about how you trade. So that's important from an opportunity standpoint. Also, commissions are extremely, extremely low in comparison. Remember, Bear Stearns used to charge $100 a trade, so that's no longer a factor. But let's remember that those commissions are there for a reason, and hopefully it turns that light on in your head where you have to think about your trade execution, so you're not just getting getting emotionally in and out of the markets without having a disciplined plan. What's more important than the commissions coming down are the tight bid-ask spreads. We used to trade in eighths back in the day, so that was $12.50 between the price you could buy and the price you could sell for 100 shares. So now, you know, your spreads now are in pennies. So and that also in the options market, meaning that you can execute a very disciplined trading plan. You can decide where you want to get in, and you can decide where you want to get out. And you can execute that because of that liquidity. When you want to get out, there are plenty of people who want to get in. When you want to get in, there's plenty of people who want to get out. What that means is risk control right now for the disciplined trader is unparalleled. And I use the word trader and investor interchangeably. A trader is someone who has a plan to make money. An investor just wants to make money. They don't have that plan. A trader knows where they want to get in, where they want to get out, and what they want to risk. So there's a major difference there. Look at that as a positive. Being referred to as a trader is a positive, not a negative. So the message that I want you to walk away with today is that there's always opportunity. Markets aren't good or bad. They just are. And I've got a little technique today that I think is amazing for these market conditions to take advantage of this opportunity. And it is extra satisfying to me making money when other people are very fearful and pulling their hair out, got their hands down, can't figure out what to do, losing sleep. It's sometimes joyful to be able to identify a situation and know how to take advantage of it, take the right tool out of the toolbox to do so. So very quickly, let's talk about where we've been, where we are, and where we could possibly be going. If you just look at the market, you look at the S&P, you can see where it traded sideways for a long period of time. For a long period of time, for about a year, nearly a year anyways, the S&P traded sideways between 2040 and 2120. So it traded sideways, 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 and you could see it had a breakdown last August, bounced back, came right back inside that channel as we've seen before. That happened in October of 2014 as well. Market had about a 10% sell-off and then bounced back. So you have to respect the resiliency of the market. Now, we've seen this breakdown here in 2016 when it violated the lower edge of that trading range. We've seen this disappointment, but it looks like we're forming a strong double bottom here. And last week, the S&P moved up. All the markets moved up to 1.5% above that 1940 range top. So if you look at these recent lows, and this is how a bottom gets put in. I'm not saying this is the low, but this is how a bottom gets put in, where we tested it on February 11th, exceeded it, and then turned around and went higher from there. So that's how a bottom gets put in. Let's see if this is the base. But if you look at this recent range, we've been trading between 1940 and 1810 in the S&P. And again, I use the S&P because that is the stock market, the broad market. The Dow is just 30 stocks. The NASDAQ is tech. The S&P 500 is a diversified market. That's what your investment managers are scored against. That's what your 401k, that's what your mutual funds are all pegged against. So you have to perform better than the S&P or you get fired as an investment manager. So if you look at that range, we had about 140 point range from 1950 down to 1810 for the last 6 weeks, broke out last week, and now we're getting a bit of follow through today. If you look at the measured move target on that 150 points on top of 1950, that target's 2100. Now, I'm not going to be the one to say that 2100 is not impossible. The market can do whatever it wants to do. Technically speaking, that is the upside target from that range. We've seen this happen before. The last 6 years, people that have been trying to pick the top in this market have been wrong, and it's been very expensive for them. There's been a lot of casualties. So let's see what happens from here, but we've seen this movie before. The fundamentals didn't change at all in 2016. Actually, they got better. Energy prices got lower. Interest rates got lower. The dollar actually came off its highs. So all those things were positive, and earnings came up better than expected. Not great, but better. And I did pull out a note here today because people say, oh, well, the earnings aren't great, the earnings aren't great. Well, they're slowing growth, and we actually had more companies beat their estimates than expected for the quarter. And obviously, we knew that the energy companies were going to have poor earnings, but how much money have they made over the last 5 years? But anyways, there's a total number here. According to the, hang on, I have this number here because I was a bit staggered by the total. Overall, S&P 500 earnings came in at $787 billion last year. Actually, the pro forma, or what the companies report when they say the adjusted earnings per share, came in at $1.04 trillion. So it's not like companies aren't making money. This low yield environment, and that's another amazing feature of the strategy we're going to talk about today. This lower yield environment, we've seen 10-year instruments in Japan go negative. Negative. You're going to tie up your money for 10 years and get a negative interest rate? That is crazy. The interest rates here on the 10-year note are at 1.75, so very, very low. Everybody's looking for yield. The stock market is the choice for money right now. Corporations are doing very, very well. They just haven't been able to keep their growth incline at the same extreme rate. They're still growing, earnings are still growing, corporations are still making a lot of money, $1.04 trillion in the S&P 500. But anyways, that's where the market is, and let's see where it goes from here. But we've got a technical bottom possibly in place, and looking at the VIX, which is important to me because that helps me determine what strategy I think I can employ based on the market environment. The VIX has come back inside that long-standing range. It traded between 20 and 12 for most of 2015. We get these periodic VIX explosions where the VIX pops up but gets beaten back down, whack-a-mole, like you see the kids play at the Chuck E. Cheese, gets beaten right back down underneath 20, and that's where we are right now, underneath the 20 level one more time. And what was important to me was the bullish divergence. What we saw last week on February 11th, we made those extreme lows in the S&P, the VIX didn't get anywhere close. Actually, it was below the January top and significantly, probably half of what it was back in August. So that's bullish divergence, meaning that the fear factor wasn't there even though the price lows were. So that's an interesting phenomenon, and that's oftentimes how a bottom is put in. But anyways, we'll have to wait and see. So the question is how to attack the markets. I've been doing this for 25 years. I've traded currencies, I've traded futures, I've traded options, I've traded stock. It's, again, not about what you trade, it's how you trade. But I'm going to show you a couple things today that I think are the best ways, the best vehicles to trade for a number of reasons. I've been doing this for 25 years, more than that actually, started in 1990. So going on 26 years. But on all sides of the market, seen it all. And what it comes down to, as we all know, it's discipline. It's simply discipline. It's all about putting yourself in high probability trades, but discipline. What I'm going to show you today is a little trick to put probability on your side. My life has changed. I used to be a very active trader, and now in retrospect, it wasn't as much fun as I thought it was. I wanted to be able to step back, but I wanted to still take advantage of the markets, and I wanted to select only high probability trades. Let me show you how to do that. So let's take advantage of these market fears, because this is a great time when others are fearful and don't know how to handle the market conditions. This is a great situation. Stay tuned to the end of the presentation. I'll show you a little quick trick where the markets made lows and people were correct on their direction. They had bought calls when the markets made new lows, but they still lost money for a couple reasons. I'll show you how to avoid that with this nice little trick. So let's talk about a couple things. Now, with these what I call lifestyle trades, and not everybody has the luxury, the skill, or the discipline to be an active trader. So I refer to these as more lifestyle trades that fit into more of everyday lifestyle, where you don't have to be glued to your screen. You can look at the markets every couple days, or I'm evaluating my positions on a weekly basis. So what I'm trying to do is use my time more efficiently, because time is your greatest asset. Let me show you how to do that here in a second, but the most important part is that I want to control probability. I myself only want to get into trades where I've got a 70% probability of success. That's it. Simply stated, 70% probability or not. When you buy or sell a stock, you got a 50-50 chance. Let me show you how to select trades that have a 70% probability or greater. And if they don't, we move on. There'll be another trade tomorrow, the next day, Friday, next week, next month. There will always be opportunities. So it's much different than it had been in years past, where if you miss an opportunity, you kicked yourself. If you don't participate in it now, so what? There's always a new opportunity. What the trick is now is to be able to pick only the best of the best. You want to find a reason not to do a trade because it's not set up perfectly, instead of a reason to do a trade. Get into that mindset. And that mindset is about discipline, and it's a very simple methodology. For each and every trade, regardless of what your financial investment is, you have to evaluate a couple basic things. Number one, the cost, and therefore the risk. Evaluate what your potential risk-reward is, and therefore in comparison to your risk. Your probability, again, that's a very important factor, so you get out of the 50-50 chance of being successful. Put odds on your side, and figure out what your break-even is. Where does the market have to get to for you to get to your break-even? Is that a modest move, or are you expecting a very significant move? And before we do that, I'm going to show you how to do this very simply using basic option strategy. Very basic option strategy. I'm in a position now where I don't trade stock. I only use options to substitute for stocks. So I'm going to show you a basic strategy to do that, to take advantage of what the market's doing right now. And so the idea is to use options instead of stocks for a number of reasons. Number one, you have limited risk, you have increased return, and so forth. There are many different option strategies you can take advantage of, whether the market goes up, down, sideways. You can make money from where the market goes or where it doesn't go. Take advantage of the time component, take advantage of the volatility component. But I'm going to make it very simple. So let's get into just a couple of basic options myths that smart people have wrong about options. There's so many people that just discount options and don't give them a chance for a number of misconceptions. Number one, people think options are complicated. Very straightforward. Very straightforward. You figure out whether your objective is that the stock, the ETF, is either going higher, lower, or nowhere. Put on the appropriate option strategy. A lot of people think options are a gamble, and if you don't understand probability and use the odds in your favor, yes, it's gambling. Okay. If you're looking for that long shot option, and just a quick story here, the guys here at the Chicago Options Exchange across the street, they make a large amount of money selling premium in the short term by selling what we call lottery tickets. What they do is they sell short-term out-of-the-money options that have a very low probability of being in the money at expiration. So what they're looking to do is take advantage of novice options traders that are buying too little time, or buying something that's got a very small chance of being in the money at expiration. So there's a reason novice traders do that. They buy the cheap options because they're cheap. And I'll show you how to get around that in a second, and how to put the odds in your favor. Number three, time. Time is an important component, and like we just talked about with those floor traders selling premium, typically they're selling front month options. Options expire every month. The February options just went off the board, not Friday last, but the Friday before that on I think it was the 18th, and then the March options are on board. The March options expire the third Friday of March, and then April, then May, and then June. So there are option series that are for each and every month. What you want to use is understand how to use time in your favor. Now, if you're an option seller, like the guys on the trading floor selling those lottery tickets, they typically want to do that with about a month left prior to expiration and take advantage of time decay. As people that have bought out of those money options, they know how they melt like an ice cube in your hands. If something significant doesn't happen in a short period of time, those options are worthless. Now that's if you're an options buyer, that's what can happen to you. So to alleviate that, what I look to do is put time in your favor by buying more time than you need. By buying more time than you need. So if I'm looking for something to happen in 2 months, I'm going to buy 4 months. If I'm looking for something to happen in 6 months, I'm going to buy a year. If I'm looking for something to happen in 3 weeks, I'm going to buy 2 months of time. Time is a very important component, and with the VIX being at these modest levels, back below 20 again, for an option buyer, the premium in comparison to what it was last year, the year before that, the year before that, the year before that, it's a relatively good value. By buying options, if you're buying the right options, you can extend the time window and give yourself a greater window of opportunity. Think about Warren Buffett. Why is Warren Buffett successful? Number one, he's got unlimited money and he's got unlimited time. He's going to be in a position until it works out. Look at some of the positions he had last year that didn't do so well. He had IBM, he had American Express, two just stocks that got crushed and beaten down, but he's confident in over the next years and maybe decades that those stocks are going to be fine, and he's got enough money to do so. So let me show you how to put time in your favor. To do that, let me give you a quick example. XLF is the ETF that tracks the financials. Now the financials, back at the time that I put this in my bullseye option portfolio, XLF had only rebounded to the halfway point, or not even the halfway point, of the pre-financial crisis high to the financial crisis low. So it's interesting that even though the markets had come back fully and had a fantastic up move, the banking stocks, for whatever reasons, really haven't participated. So XLF is a financial sector ETF that tracks the banking stocks. So what we were looking at here was that you can see the yellow boxes back in October of 2014. XLF was trading at what, 22 or so, 23? And the thinking was that over time, that it's going to play a little bit catch up to the rest of the stock market and see a movement upwards. So the trade selection was an in-the-money call. Again, very, very simple. But I'm going to show you a couple unique facets of this that you probably were not aware of. So an in-the-money call. So if you looked at the low for that year was 1948. Buying the 19 call gave you the right to be long from lower than it had been all year. And it cost $425 for that right. So take that $425 and add it on to 19, and that puts your break even at 23.25. And at the time, the market was trading at about 22.75. So the break even on that was about 50 cents higher. Now this particular option had more time than I needed. It had 400 and some days, so it had 1 year and 4 months. So what I was simply looking for was XLF to move up 50 cents or more in the next year and 4 months. A very modest goal. So what that means is, and that's how I set up a lot of these trades, that I want to be able to profit if there's just a very modest move. Okay, and if there's a good move, obviously it's going to have a big payoff, but I want to be set up for just a minor move to still be profitable. So my break even was 50 cents higher, and I had a year and 4 months of time. Now that's a lot of time. Things are going to change dramatically in a year and 4 months, but you can see hopefully how I extended that time window to give myself a greater opportunity to be successful. And that's the trick. Now let me just show you a couple of things. If you look here, the delta on this was 84%. The delta on an option is simply the percentage that option moves in comparison to the underlying. So if the underlying moves up $1, this option should move up 84 cents. So what that tells us, it's going to act very much like the stock. This is my stock substitution strategy. Instead of buying a buying or selling a stock, I'll buy an in-the-money put or call, but I want to buy a deep in-the-money put or call that's going to behave like the stock, and I'm going to buy enough time to be right. But also, for this 84%, this delta is the approximation that that option will be in the money at expiration. So it's a probability approximation. So there's an 80-some% chance that that option will be in the money at expiration. So again, as opposed to buying the cheap out of the money option, I want to buy something that's in the money that's going to behave like the stock that has a high probability of success. So you're paying a little bit more money, but what you'd want to do is when you're buying an option is risk half of it, typically is what I look to do, because if the market moves the other way or you're running out of time, that's when your option will lose value. So it's probably a good idea to get out of it, salvage what you can, and look for other opportunities, because there's always other opportunities. So over time, you could see that the option gained 50%. So that's another important aspect of this, that even though there was a move in the underlying stock that wasn't a home run type trade. You know, it moved up to, let's go back and I'll show you, it moved up to what? It moved from 23 up to 25, all right? So a $2 move in the stock, a 10% move in the stock, but what's important here, by using that deep in the money option, the right option, you had a 50% return. Now, yes, it did take 8 months, but, you know, time, you want to have as much time as possible. You want to use time to your advantage. A lot of my trading friends here in the city give me a little bit of a hard time about, you know, buying so much time when I'm trading options, you know, and that's just the way that it fits my lifestyle. I don't want to have to be looking at the markets on a day-to-day basis. I can look at them more on a weekly or more on a monthly basis, even for some of these longer-term positions, and be there for that opportunity. A 50% return on a on an option investment is significant, no matter how you look at it. So that's just a quick example of stock substitution. I'm going to show you the trade strategy in a few minutes that I think is most appropriate for these market conditions. But I just want to get at a couple of these myths here. A lot of people think the options are risky, and actually the worst thing that can happen is if your option buyer, it expires worthless. So you have absolutely limited risk. That option for $425, that's the worst case scenario, it could go to zero. No matter what happened to the underlying, the worst case, that option goes to zero. Again, put in a stop loss at half of what you pay, but you already have risk control built in. Whereas if you're trading, you know, you're trading futures, you're trading currencies, you're trading stock, you know, those markets can be just as risky, and they don't have the built-in risk control factor. So just be aware, it's not what you trade, it's how you trade that's important. And number 5 is, a lot of people think options management takes too much time. Hopefully you can see with that XLF strategy, usually I show this McDonald's strategy where McDonald's in 3 weeks just last fall, the option gained 100% when McDonald's had a nice pop up. Everybody had been negative on McDonald's. McDonald's had been one of the worst performing stocks in the Dow. And it just got to that point where it had, the risk reward was skewed on the upside, and that was also another example of bullish divergence. When it made new lows, you didn't see new highs in volatility, so that was a signal. But anyways, the idea is a lot of people think that options take too much time to keep, you know, to analyze and to manage. That's not true. I use options as a vehicle. Again, I'm just looking at the big picture. I'm looking to see what's going to happen in the next 3 months, 6 months, and positioning with options so I have that extended time window, and it fits more my lifestyle. I've got a small daughter. I want to take her to school. I want to pick her up from school. I don't want to be chained to my computer. I want to be able to, you know, to take her to dance, take her to softball, do all these activities. Now she's in school, but when she was little, that's what I wanted to be able to do. So that fits my lifestyle. You're still taking advantage of the opportunity, but it fits the lifestyle. Today I'm going to show you a simple strategy to take advantage of high relative volatility. Now there are individual stocks, and there are a lot of them right now, that have been just absolutely crushed. A lot of these commodities, metals, miners, energy stocks, you know, are down 70% in the last year or two. So there are some stocks that have some individual high relative volatility that we want to take advantage of. A lot of single-digit stocks that I'm sure you're looking at out of the corner of your eye thinking, you know what, at some point that stock is a buy. You know, let me show you how to buy it, and buy it even lower or get paid not to. So the cash secured put sale strategy is what I want to get into today. What we're able to do is buy the stocks we want at a lower level or get paid not to. So the options wheel employs the cash secured put strategy, and I importantly phrase it cash secured puts, meaning that we have the money in our account to buy the shares of stock if it gets put to us. So typically we're looking at more inexpensive stocks, and the idea here is to get small monthly returns, selling those options like the floor traders do with the lottery tickets, those out of the money options that very, very rarely come in, selling those, doing those in a very controlled manner to generate, you know, 5, 6, 7, 8, 10% in 30 days. Now people are going to say, well, 5%, that's not a fantastic return. It's not, but if you annualize it, you can do that on a consistent basis with a 70% probability each and every month. You can do it on the March options, and then do it a handful of them on the April options, then do it on the May options, and so forth and so forth. These small returns add up, and one way to look at it, you're doing this in addition to your directional trades, in addition to your other trading. It's something that runs in the background to kind of complement, not supplement, complement what you're doing. You're generating returns on a consistent basis, not hitting home runs, but hitting consistent singles. And to illustrate that, I often bring in this rule of 72. So someone's going to say, well, 6% is not a whole lot. I guess in this environment it is actually, because yields are so low. But let's say you get 6% a month, and I'll show you a couple here that we just put on we just got out of in the February, and we're just putting on March positions that have that had that return in a period of a month. But take your annualized return, all right? Take 72 divided by your annualized return. So if you can get an 8% return over the course of the year, take 72 divided by 8. That means that you will double your account. The rule of 72 says you will double your account in 9 years. So think of it in those terms. Slow and steady wins the race. And that's what we want to do, is have this in addition to your other investing and other trading. This is running in the background to increase your portfolio as well. Now, this is simply an investment manager trick that they use to build a portfolio. So if you're an investment manager with hundreds of millions of dollars and you want to buy into a stock, you can have a choice. You can put in a price down below and wait for the market to come to you. Or you can use this as a way to get into the stock. Or if you don't, you get paid by not buying the share. So let me just show you an example using Apple. Apple at the time was trading around 110, and it was 15% off the highs. So if you're looking at Apple and you found it attractive, you could say, well, listen, you know, I'll buy Apple, but I want to buy it closer to 100. I could put in a price and a limit order to buy 100 shares when it hits 100, or let's say we could buy it at 102 and risk it to 100 and just sit there and wait and wait and wait and wait. Or your other choice is to sell the 102.5 put. Again, you're selling a cash secured put. You have the money in your account, and you're prepared to buy the stock at a lower level if it gets put to you. Now, Apple's a very expensive stock, but I'm using this for illustration purposes. So you sell the 105 put, you take in 250, so that puts your break even at 102.5. So you're prepared to buy Apple at 102.5. So 102.5 times 100 shares is what? $10,000. So that's what you'd have to have in your account to be able to sell one of those options. Now you sell the option there, and it was the November option, about 30 days prior to expiration. So either Apple's below that 105 level at expiration, or if it's not, you get to keep that $250. So you get paid by not buying it. And then the next month you would sell the December option, sell a December put, and then January put, until you get into the stock. Oh, you know, you're getting paid. That's the idea. You want to buy the stock. This is just a way to get into it lower or get paid not to. So a couple rules for the cash secured put strategy. Only stocks you want to own. I can't stress that enough. Only stocks you want to own. You might be in it for a period of months, maybe even years. But what we're going to look at here today is very important. They're high volatility stocks, but they're typically lower price stocks. Stocks around the $10 level. And there are plenty of them now. Freeport-McMoRan, U.S. Steel, what do I have here on my list? Southwest Energy, Gold Corp, Marathon Oil, plenty and plenty of stocks that are down here at the $5 and $10 level. So when you put on a $10 stock, you know, what's your downside? You know your maximum low is zero. A stock could go to zero. Obviously, it's most likely not going to do so in the next 30 days, but anything's possible. So they're lower price stocks. So you don't have the exposure like you would on a $100 stock selling that put. Just like a covered call, that's important here. You have the same risk profile here on a cash secured put as you do on a covered call. You don't do a covered call on a stock that you think could go down, you know, from $100 down to $50, because the dollar you took in by selling covered call is not going to help you if the stock loses half of its value. Again, by doing this, you have limited your downside if you're doing these low dollar stocks, and there are plenty of them. Think about who's the GoPro, all right? GoPro, Twitter. You know, a lot of these stocks have come down so far. If you want to buy them, this is a great technique to do so. So I'll give you a quick example in Sprint. Actually, let me just shift over here, and I will go to a trade alert to find a recent, here we go. All right. Here we go. Let's go with Gold Corp. Here's a recent example. So this was back January 22nd. At the time, Gold Corp was trading about $10. So down there near decade lows, all right? What's the downside? Okay, downside is $10. It could go down to zero. So gold is a tangible metal, so barring the company having too much debt or any other accounting nonsense, you know, they have real value if they have real gold. But anyways, Gold Corp stock had been drifting lower and lower. So that was attractive. So what you could do is you could sell a 950 put, for 40 cents. All right, so you're taking in 40 cents per option you sell, so that's $40. So that works out to be a 5% return in less than a month, or you're buying the stock 9% lower. So either way, it's a win-win situation. So if you take that 40 cents off of the 950 strike, your break even is 910. So if worst case scenario, you're buying the stock at 910 when the low I think was 946. You're buying it below decade lows. That's your worst case scenario. Something you can live with. You have the money in your account to do so. It's all about probability. That's the idea. It's all about probability. If you look at the delta here on that 9 strike was about 25%. 910 was your break even. So therefore, there was a 75% chance it wasn't going to be below 9 just based on the implied volatility, based on the probability. So what you're doing here is you're generating revenue. So as long as the stock's above 950 at expiration, which it was solidly above that. Let me just find it here on my chart. So let's get into that. So Gold Corp, if we want to find that, on the third Friday of February, which was the 18th. So the 18th of February, you could see that the market made a bottom and rallied significantly, and then the 18th finished up at 1577. So that obviously is significantly above that break even, that 950 strike that we had sold. So that pocket's 5%, and now we go out to the March options and start looking at the February options going off the board. We start looking at option series, looking at the March for additional opportunity. That's the thought process behind it. Here's a quick example of Sprint from a time ago to just see how the idea works. Sprint stock was at 560. You were able to sell the put below for 20 cents, a 4% return in 3 weeks. The idea here that you profit if the stock moves up, the stock moves sideways, or even if the stock moves down. And if it moves down, as long as it doesn't move down more than 6% below the stock price, that's the break even, then you're in great shape. If not, you're buying the shares at a major discount. So that's the same example there in Sprint. The idea here is, thank you, the idea here is to get the stock at a price you want, at a low level, or get paid not to generate monthly revenue. So here's a couple examples from the portfolio back, like I referred to, October of 2014, when the markets came completely unglued. Everybody lost their minds, selling some cash secured puts. And the returns on these puts, 4%, 12%, 6%, 4%, 7%. You typically do, I'm looking at a portfolio of these stocks each and every month, so you're generating high probability returns. Again, I'm choosing trades that have a probability of 70% or greater to generate these returns in addition to our other trading investing. So the same scenario happened here in the fall, if you remember. Happened in August and September, so that was an opportunity to use this option wheel strategy, selling the FCX puts, taking 40 cents, selling the SUNE puts, taking in 60 cents, selling US Steel, taking in, what do we say here, 60 cents. So the idea here is, and to me, it's a win-win situation. Either buying a stock I want, 13% lower, getting paid 5% in a month not to. Buying Sun Edison, 17% lower, or getting paid 10% not to. US Steel buying 15% lower or getting paid 5% not to. So this, it takes advantage of the increased fear, that increased volatility, that spike in volatility where other people are fearful and just are throwing everything out the window. We're taking advantage of that with this strategy. So that's just an example of the approach that I use to turn lemons into lemonade, to turn that frown upside down, to take what some would say is a bad market and turn it into a good market, a high probability market for you. Here is the US Steel. Now we went back to US Steel, selling the 13 put, meaning that you buy the stock 15% lower or get paid 5% not to. Now the FCX and the SUNE, they ended up above our strike price at expiration. We get to keep that profit. US Steel was a very interesting situation, that stock went down 15% in a month. 15% in a month is a huge move in this stock. But guess what? It was still above the break even at expiration. It went off the board at 1948. Our break even, selling the 13 put for 60 cents, our break even was 1240. So even though the stock went completely the other direction, 15% against us, the position was still above our break even expiration. So that illustrates how it's a win-win situation. A win-win situation. Now, if you took the stock, let me get into the option wheel component here. If you took the shares and were long from 1240, when that option goes off the board, you had that $1,240 in your account to buy that 100 shares. You're okay with that. And because of that increased volatility, here's where the option wheel component comes in. You then sell a covered call to lower your basis once again. So in that example, you could sell the next month's covered call for 80 cents, lowering your basis to 11.60. So that's an example of selling a put, getting the stock, selling a covered call, and then getting it taken away when the stock rallies for profit. So the trading rules for using cash secured put strategy was, I think, is very apt for these market conditions. Only stocks you want to own, stocks you could be into for a period of weeks and years, because what happens is if you get into that stock, U.S. Steel, and you sell that covered call, that lowers your cost basis, and if it doesn't get taken away, then you sell the next month's covered call and sell the next month, and continue to do that every month to continually lower your premium until you get it taken away. So these are stocks that you have the money in your account that you're prepared to own for months, maybe even years. Typically high volatility, lower dollar stocks. It's simply probability. It's all about math. Like I told you, I'm looking at this point in my life to only trade positions, put on trades that have a 70% probability or greater. The process here is to sell the put, get the stock, sell covered calls, and then repeat. Only stocks you want to get at a discount or get paid not to. Again, it's all about probability, creating a revenue stream and repeating. The beauty is these options exist for every month, so you can repeat this every option expiration series. So very quickly, I'm going to get into these recent trades here that we're getting into right now for the March option series. Had put on a position in where are we here? In U.S. Steel, all right? Here's another example of U.S. Steel once we got called out of it. Because it's a low dollar stock and it's got a nice fat volatility, we're able to do this on a consistent basis. So the idea here just the other day, this was on the 23rd of February last week, we're able to sell the $7 put for 40 cents. So what that means is if the stock gets put to us, we'll be long from 660, $7 minus that 40 cents, 660. So there's a 78% probability that it'll be above our break-even expiration. So either buying the stock 18% lower or getting paid 6% not to. Again, it's all about the math. Here's the chart on U.S. Steel at the particular time, trying to bottom out and moving sideways. But because of that increased volatility, if you look here, you can see that increased volatility, you're able to sell that out of the money put, again, 16% lower, or what was it, 18% lower, able to buy the stock 18% lower in the next 25 days or get paid not to. A trade that we just initiated here today, looking to get into Southwestern Energy, selling cash secured put on Southwestern Energy, selling the $5 put for 30 cents. So what that gets is it gets a 6% return, or buying the shares 15% lower. And if you look at Southwestern Energy, $5 is the decade plus low, and that would put us in at $470. Again, $470 per option that we sell. So, you know, it's something, it's a way to get into the stocks that we would like to at even a lower level or get paid not to. So I can answer a couple questions, and then I'll get into my option service and what Bullseye Option is all about. I gave you a couple examples. I showed you a couple of the trade recommendations on the screen so you could see the process. Like I said, I'm not an active trader. What I'm looking for here is to do a couple of trades a week and look at things with more arm's length distance. So if you have any questions, be happy to do so. Someone asked me if I use weekly options. In this particular strategy, I don't. But you could, you know, you're looking at the time decay curve a little differently. Typically with monthly options, they start to lose some of their value the last 21 days prior to expiration is when that time decay curve really starts to accelerate. So I'd have to play with it a little bit, but what I like is I like to be able to evaluate, make sure that I've got a 70% probability of success, and that to me is what's most important using this option strategy. Now again, this is not the only strategy that I use. This is just something that I can do in addition to whatever's happening in the marketplace. And I showed you earlier the stock substitution strategy that I use on XLF, you know, buying in the money calls or puts to act like the stock, and what the parameters are of that. A couple people asked some questions here. I like Thinkorswim, and I like Trade Monster as far as platforms, because it's all about options for those guys. That's what's very, very, very important. Another question here is about allocation, and that's really, really important, I think, is to make sure that you divide your account into equal slices of pie, so each and every trade has the same weighting. So what I would like you to do is, if you can, is divide your account into 20 slices of pie. So every trade you put on is using up 5% of your account. Again, if you're putting a stop loss at half, you only have 2.5% of your account exposed at any one time. So if you're wrong, you're wrong. This is about a long series of highly probable events over time. And remember, it's not about today or tomorrow. It's about next week. It's about next month. It's about next 6 months from now. It's about next year. So someone says they live in Chicago. Options Express. Options Express, sure. They specialize in options. You want to find a platform that you're comfortable with. But the idea here is platforms are, trade execution is very similar. Just find out what works for you and what you find comfortable. And commission prices are all very similar as well. So it takes that factor out of the equation. Let's see, what other questions do we have here? So yeah, just experiment. And one of the things I say with Thinkorswim or with Trade Monster, you can also use they have paper trading features, so you can see how things develop and practice your skills. The markets are always going to be here. And one thing I'll always tell you is start as a one-lot trader. Learn a strategy, trade one contract at a time to start with. Well, you're not going to make a whole lot of money. Most importantly, you're not going to expose yourself to a whole lot of losses or a big financial loss. Learn a strategy. You can always become a bigger and better trader. They become a 2-lot trader, 5-lot trader. It's not how many contracts you trade that's important. I know some people say, well, I want to be a 5-lot trader. To me, it's more important that you allocate a certain dollar amount. So if a trade's $500, that you allocate, if you're putting $1,000 in each and every trade, then you're putting on 2 positions. So it's not the number of contracts you trade. It's more about the allocation that I think is important personally. So let me tell you quickly about my Bullseye Option service, bullseyeoption.com. My Inner Circle membership. There's a couple things that I think can give you a lot of value. Number one, I do these online training seminars, these power sessions every 2 weeks for my subscribers, where they can come to me, ask questions. We'll evaluate what the markets are doing, what they've done, what we're looking for them to do, look for some trading candidates, talk about the positions we have, answer questions. It's kind of a group coaching session as well, so that as you come to me with some stocks you're looking at, some strategies, we can talk about the positives and the negatives of it. Also with this service, you're going to get a nightly Where's My Head At video. I often appear tomorrow morning. I'm on Bloomberg at 7:10, then I'm on CNN International at 8 o'clock Central Time. So I'm often on the major financial networks, and I'll put those videos in there so you can see exactly what I'm looking at and why, what market and where and how to play it, and what are key levels that I think are important, what I'm looking at to happen and continue to happen, and most importantly, how to take advantage of it. You'll also, obviously, part of the service is that the timely trade alerts that, like I said, typically 1 or 2 a week at minimum there, so you're going to have some things to evaluate and look at. And I showed you, looking at the Bullseye Option page, I showed you some of the trade alerts, and they're not just what to buy and where. They're really long and drawn out. They talk about the market, the sector, the stock, and the right option to put probability on your side, what to risk, where to get in, and where to get out if things go for you and go against you. Most importantly, hopefully you can see that I focus on probability. Focus on probability. I only want to trade trades that have a 70% probability of success or greater. Sign up, bullseyeoption.com/TRY, $7 trial for 1 month of this service. You're going to get a lot of information. Also, you're going to get a morning commentary where I'm going to talk about what happened yesterday and what I'm paying attention to as far as the market movers for the day in the morning as well. That comes out at 7 in the morning. So you're going to get a plethora of information and commentary and some good market analysis and good high probability trading candidates to take advantage of it. To get back to that aspect of being a 1-lot trader, this gentleman sent in his testimonial, made a significant amount of money on a trade. Now he traded size, okay? He built up the level where he was trading a very, he's had a large portfolio and a large account. That's not the point I'm trying to make here. The point I'm trying to make here is that GDX at that particular time moved up, I think, 7 or 8%. And the idea here is with the right option strategy, a 7 or 8% move can be compounded, and that option had a 53% return in less than a month. So that's what's important, that you have the right option strategy to have that power of leverage with limited risk and high probability to take advantage of it. So what's important here was a 50% return. The right option had a 50% return, whereas the underlying moved up 7%. So I'm not looking for long shots. I'm not looking to gamble or looking to hit the home run. I'm looking to have a series of high probability events to be successful over the long term. So sign up, bullseyeoption.com/TRY, $7. You get a month of this Inner Circle membership, like I talked about, a plethora of information to get you in the game and hopefully shift your mentality to be able to identify and take advantage of these opportunities. Good markets or bad markets, they are what they are. But you have to have the right attitude that there's money to be made at all times. There's no reason to, worry about what the markets are doing. It's just how to take advantage of them. Have the right tools in the toolbox to take advantage of whatever the markets throw at us. And like I said, there's a certain satisfaction being able to make money when others are just at a loss and just can't figure it out. It's very interesting to be in the right mindset, like I said, to be able to turn that frown upside down, to take those lemons and turn them into lemonade. And, well, I think the market, because of my optimism about the resiliency of the market, like I said, I don't think personally the fundamentals have changed. I don't think it would be unreasonable for the market to come back one more time. Anything can happen, and I'm certainly not going to be the one to say that the top's in the markets and that's it. We're in bear markets from here on out. There are certain politicians that have an invested interest, as I'm watching the TV out of the corner of my eye, to say, the economy's not great. Well, the stock market is not the economy. The stock market is a different opportunity. Corporations are doing fantastically well. They've got a low interest rate environment. We've got still strong earnings growth. We've got the dollar slowed its incline. We're not raising rates anytime soon. So none of the fundamentals have changed. So that opportunity still is there, where our stock market is probably the best equity market in the world as far as opportunity goes. Someone asked about in London, which broker do you recommend? That's interesting. I don't know. I always get that question from Canadians. Canadians have very strict rules as far as which brokerage firms, and now because of the money laundering laws and anti-terrorism laws, it's not as easy to open accounts as it used to. They're a little bit more diligent on the background check. So look around or send me an email and I can find that out, because I've got a couple of trading friends that are in London, and they can give me some advice as well. So so let me just give that to you right here. Any questions that you want to send to me, please do. And let me just give you this email address, Alan. Hang on, I'm pressing the wrong button here. So it's Alan Knuckman. I'll give you my, hang on, I'm stuck on something here. It's frozen. Bullseyeoption.com/TRY is a $7 1-month Inner Circle membership. Sign up for that, find out what it's all about, see if you're going to get some good ideas, some good optimism, I think, as well, because you have to be in the right frame of mind to take advantage of these opportunities. And again, it's all about probability. You can't let any one trade have any dramatic impact on you financially or emotionally. That's terribly important. And a lot of times people get kind of married to a trade, and this one trade just takes them down, and they fail to recognize new opportunities. They fail to continue to do what they've been doing to be successful because they have this one trade go against you. You're going to be right, you're going to be wrong. That's the idea. It's about being right more than you're wrong and taking advantage of the long string of highly probable events. That's what this is. That's what trading is all about.